Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this program on whatever platform you happen to be using. Well, it's that time of the year for the second quarter earnings reports. We'll take a look at what you might expect to see happen. The one big beautiful bill is now law. We'll see what its impact might be on investors, and we'll have a discussion about AI and its impact on jobs. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining me for The Bull, the Bear, and You. You know, since the last time we met, we've seen new highs once again for the NASDAQ and the S&P 500. I call this podcast The Bull, the Bear, and You, and right now it seems the bulls are grazing and just fattening their portfolios as two of the major indices continue to set new highs. In the woods, always lurking, are the bears. In the past several years, they have chased the bulls on a couple of occasions, but then they retreat and never really dominating the feeding grounds. Now, whether the bears try to come out of the woods once again may depend a lot on the second quarter earnings that companies will begin reporting this week. So, Kim, let me ask you, what do you want to see to support these new highs we've seen in the market?
Sure. Well, like the true fundamental analyst that I am, I want to see companies raising their guidance. Guidance is what companies say is going to happen for the next, hopefully, 6 months to a year on their earnings and their revenue. I'd love to see their prospects for revenue increasing. And we have to remember that in the last quarter, because of the tariffs and the timing of the tariffs, which was just before earnings season, a lot of companies pulled guidance because they did not know what was happening. Well, we have a foreshadowing of what might be happening in earnings season, because Delta Airlines, one of the first companies that pulled guidance saying we don't know what's going to happen because of tariffs, they've reinstated guidance in the last week. So I expect a lot of companies who probably correctly pulled guidance because they didn't know what was going to happen are reinstating guidance, and I would love to see those numbers creep higher.
Not only did Delta reinstate it, but they said that consumer looks pretty strong, flights look pretty good. I mean, their stock was up 15% along with the other airlines right after they came out with that. So to Kim's point, I mean, you're going to finally start to see some clarity on what the tariffs might have meant then. I mean, again, it seems like it's changing again right now with the tariff news, and I guess nobody's really going to have a lot of clarity on that. But Amazon Prime Day, which is now 4 days long, just ended, and they had record sales numbers there as well, I believe. Consumer still looks pretty strong, even though I think we're starting to hit the later stages of maybe the economic cycle a little bit. But again, to Kim's point, company guidance is really all that matters. Not really what happened in the past, but what happens kind of going forward.
Yeah, I agree. People are a little confused as to why the market has gone up as much as it has. And as we enter earnings season, the one thing to keep in mind is that it's always about expectation, right? Like, what have they done versus the estimate? And estimates were kind of low. So I think that in light of lower estimates going into this earnings season, as long as companies were able to achieve that, I don't think that we're going to necessarily, see a reaction to the actual earnings. They should be able to meet them since they lowered them. But it does come down to guidance. And as far as the economic news and consumer, our economy is still 70% consumer. So paying close attention and trying to get ahead of the curve with that is important. And there's some conflicting information. We want to watch unemployment. Unemployment is huge, right? People need to be working. And the employment numbers have actually been pretty good. They haven't been bad. What we get more concerned about is just the level of debt, and particularly credit card spending that we see that has reaccelerated. So we want to make sure that we're keeping an eye on that, and also keeping an eye on what is happening from a consumer perspective with tariffs, and what consumer goods are being directly influenced by that.
When you say debt, Carrie, I assume you mean consumer debt, not government debt?
Yeah, correct.
Because that
Although
is
that's
a whole other
followed
can of
too.
worms.
Fortunately, the government debt happens a little at a time, and so far that government debt has been absorbed by the market pretty easily, and surprisingly so. As this goes forward, more so next year than this year, we'll see how that plays out. And although interest rates are being tried to be talked down, at this point, because of what Kerry said, strong employment, strong economy, inflation is not crazy. I think that for the overnight rate to come down, it would be difficult. But it seems that the long-term rates are hanging in that four-handle place, surprisingly, and not moving up at all. And that's rather interesting, considering the amount of borrowing that's being done both by consumers and governments. And now we're going to go into all this defense spending that everybody deems necessary, probably correctly. And that's more borrowing the way I look at it. It'll be interesting the next few years, actually. It's not the next quarter.
Well, I'm going to throw this out here. The president would like to see the Fed lower interest rates. You see it happening in other countries. They lower the interest rates. Would it help or hurt the economy right now if he were to if the Fed were to lower interest rates? In other words, would it cause just more inflation again?
I have a nuanced view of inflation. I believe that what interest rates really affect are things that you borrow for. So that's housing, new capital expenditures if you're a company. And the government does its own borrowing, but it seems pretty immune to whatever the interest rate is. They just borrow, right? But one of the most interest sensitive areas is housing. And it is lagging right now rather severely. And I think that, in the world of too many dollars chasing too few goods, I'm not sure that a mortgage is all that inflationary, because people are getting a mortgage and they're looking at their cash flow. So they're not adding to the cash flow of the nation. They're just using their cash flow towards a mortgage purchase. I'm somebody that strongly believes inflation is a monetary effect, and so printing money is the issue.
Which is what government deficits effectively are doing, printing money. And I've been hearing this for 50 years. It's been a problem. It's been deemed a problem for 50 years, and so far it seems to be absorbed. We had a wild bout of inflation back in the late 70s and early 80s, but I'm not sure that had to do with government deficits. That had to do, in my opinion, more with the baby boomers hitting the economy and all needing pots and pans. And we just bought stuff that couldn't be built. And we may be entering a thing like that now, where there's more money and fewer goods, as Kim just said, because manufacturing is running pretty well last I saw.
So this is such a great question, because it opens up Pandora's box on so many levels. To Kim's point, I think the reason why the president feels that interest rates should come down really has to do with housing. And housing is a big driver in our economy, because you buy a house, and then you go to Home Depot every night for 3 months, and then you order all kinds of furniture online, and a year later it shows up. But that's another story. So it drives, if you want to drive manufacturing, right, producing things like washers and dryers and things like that. But then, the other part of this Pandora's box is, but now we're going to assess a huge tariff on copper, right? Which is a necessary commodity for manufacturing. So that's a whole nother story. But I think that the problem, right, you have to look at, well, what's the problem? Why, even with relatively low interest rates, why is the housing market slow? And it is supply and demand, because guess what? Builders don't build affordable houses. So you have a population who, quite frankly, just can't afford to buy homes because we haven't built enough homes. We haven't built enough affordable homes. So it really kind of opens up a whole nother issue about, what builders are doing, and how they've approached what types of homes that they're building. So it really creates quite a predicament.
And one of the reasons housing is unaffordable is land costs have become outrageous. I mean, people are buying $300,000 and $400,000 houses and tearing them down to build a house.
Mm-hmm.
Now, those are people with means. If a first-time buyer, that person can't, of course, even consider doing such a thing. So they end up moving to Timbuktu, 30 miles from their office, so that they can buy a land for a few thousand, some land, and put a house up at a reasonable cost. Whereas these land costs are outrageous, and in order to have that make sense, you can't put a 2,000 or 1,500 square foot house on it because the land's too expensive for that. So there's a whole bunch of supply-demand issues that are in play here, creating these problems. And one item like interest rates isn't going to change it alone.
Yeah,
All right,
it's really,
go
it's
ahead.
a fascinating, trends in the marketplace, any marketplace, happen over decades. And it's just really fascinating to look and study, kind of back to the Industrial Revolution, and, how people lived in the cities. And then, you in the 40s, 50s, 60s, you had like suburbs created, right? People started to move out of the cities, and now they've started to move back, and the prices have escalated so much. So now we're seeing this trend back to the suburbs. And how do you define that, right? Like Frank said, you go out to the suburbs, people are buying houses and tearing them down. So the only solution now is to go further. So it's a very interesting case study.
All right, I'd like to move on to something else here. There's been a lot of back and forth in the political world on the passage of that one big, beautiful bill. Let's put the political commentary to the side right now, because I don't think any of you really want to get into politics. But Michael, for the investor, what are some of the highlights of this big, beautiful bill? I presume that one of the major things would be taxes.
Yeah, I mean, I'd love to get into politics, but we can put that aside, Stacy. That's fine. There's a ton in that bill. To be honest with you, I don't know how much of it actually is going to impact in regular investors in the markets, right? I mean, the bill it makes permanent Trump's 2017 tax cuts, which I think is already sort of baked into the pie from a market standpoint. I think you have a lot that just helps individual people that might, whether it's new relief for, deductions for Social Security. I know Trump wanted to make, just reduce the taxes for Social Security, but couldn't do that, so he gave them a big deduction to have seniors to have on your Social Security taxes. You have an increase in the SALT deduction up to $40,000. There's tax breaks for tip income and overtime pay and all that fun stuff. So in the end, hopefully it just means a little bit more money in some people's pockets that can eventually make its way into the market, which is kind of what we're talking about here. I think, Kerry talked a little bit about copper tariffs there. I think the bill does aim to accelerate sort of, the domestic sourcing of some of these critical materials. So how that actually plays out in do you want to invest in companies that do, copper mining and whatnot is sort of to be seen, I think, right now. But from the ability for us as portfolio managers to say, this is where I want to direct our clients' money, I think it's still a little bit too hard to do that right now. And the bill's so big and a lot to unpack that I'm not sure it's really going to play out as seamlessly as maybe some people might think.
Yeah,
Go
Go ahead,
ahead.
Frank.
what I've read is that the bill is really a bunch of little things, and that's the problem. Yeah, it's going to help the seniors. They're going to get a bigger. They're going to get a tax break. It's going to help people. It's going to help people who don't itemize deductions to get a bigger standard deduction. So the lower income people will pay less tax because the standard deduction is going to move up to 40,000. I don't know what it is for single filers, maybe 20. I don't know. The point is, higher deductions mean that they'll pay tax on less of their income, and all these things are good for the economy. I'm not sure they're good for the balancing the budget, but they're good for the economy. And that being said, it certainly won't hurt growth rates. Let's put it that way.
The one thing I love about this bill is that it helps the little guy. You know, it helps people that have to work overtime to make ends meet, or, you know, they work at a restaurant and they get tips, and now those tips to a certain extent are not going to be taxed. You know, it gives people a lot of the things in this bill have phase outs. So once you get into a higher income level, you really don't benefit from it. But for those lower income earners, I think it does provide some relief. Probably the biggest thing for everyone is that this extended the previous tax cuts that were due to sunset. So, you know, across the board, as we look at how this impacts investing, I don't really think there's a lot here that's going to have a dramatic impact. You know, the first time around, I think it did have a dramatic impact because we saw tax rates come down pretty much across the board. But this time it's just kind of an extension of what's already going on.
But Carrie, I thought this bill only helped billionaires. Am I wrong? In
Help
that?
what?
Only helped billionaires. That's what I keep reading in the news. It's
that's
only
standard
tax cuts
deduction.
for the billionaires. No, that's not right, huh?
Well, it really doesn't. I mean, even the SALT increase, you know, anyone over $500,000 of earnings, you know, that's why I say it really does help the little guy. But if this bill was positioned to, you know, help high income earners, it hasn't. So, and that's really why I wonder, you know, we talk about the impact that this will have on the deficit, and I know that you read all the projections out there, but I don't believe this bill really kind of impacts, I just don't know the percentage of people in that higher income, the people that are responsible for paying most in taxes. I don't know how much this is going to reduce their taxes, to your point.
I think the estate tax is probably the only big thing for those people. And most of the people, I think the number's like 15 million. That's so few people, I'm not sure it really matters. And those people that have, the Bill Gateses of the world, have it all figured out anyway. They're not going to pay much estate tax. They handle it long before they die. And so I just don't know that it's a big deal. And like you were alluding to, Carrie, I read this thing and they talk about the dollars that it's going to cost. And I read what they've done. And I know that the 40,000 sounds like a big deal, but it's a big deal to people who don't pay much tax anyway.
Right.
And as far as the aggregate dollars collected by the government, it's a big deal to them, but not to the government. And I wonder if they're not adding money that's already was saved in 2016 or 17, and they're just doubling it up because they have to fill up their column inches.
So one of the areas that investors should pay attention to, because I think we've already figured out this bill isn't going to really sway investing one way or the other, but it's where the government, the executive portion of the government, can direct regulation and how that's interpreted. And I think that you can invest in areas that are highly regulated that are probably going to get a little relief. And housing would be one of those. We see this happening not even at the federal level, but at the state level in California, that they realize they've over-regulated, right? So they have to back off of some of that. But a lot of the chemical plants, oil refining, things like that, and probably mining, especially in light of the copper. Although, just personally, I hate investing in commodities, but that's a whole topic for another thing, another topic. But yeah, look at areas that are highly regulated for a little bit relief, and they might be able to report better margins over the next several years under this administration.
I noted that, by the way. It's going to be one of our topics for a future discussion, investing in
good.
commodities.
And
On our
you're
last
the only
session,
one on, Kim. You're going to take the whole episode.
No, I'll just complain and then you guys can clean up the mess. Because I have like 3 reasons why I hate commodities.
we'll save them and we'll go into them
Okay.
next time. All right. In our last session together, we talked about AI and about investing in it. But Carrie raised another issue in that it could be a double-edged sword. It can increase productivity, but also mean fewer people are working. Frank indicated that there's a population decline underway worldwide, so maybe things will even out in the end. Well, not long after our discussion, this headline in the Wall Street Journal, quote, CEOs start saying the quiet part out loud. AI will wipe out jobs. Ford chief predicts AI will replace literally half of all white-collar workers. It's not the head of Ford either. This is a quote from Micah Kaufman of Fiverr to his staff this spring. This is a wake-up call. It does not matter if you are a programmer, designer, product manager, data scientist, lawyer, customer support rep, salesperson, or finance person. AI is coming for you. So, my question, not which AI company is the one to invest in, but rather, what will be the impact in general? Do you invest in a company that will increase, that will become a leaner, more productive, and be able to increase its bottom line? Or should we be more concerned about the loss of jobs, thus fewer people with higher incomes supporting the economy? Since Carrie and Frank brought this subject up before, I'll let one of you guys start. Go ahead.
Let me start by doing a little history lesson. They said the same thing when Benz and Ford created cars, which was high tech then. There's blackjack. The blacksmith wasn't going to have a job, and what we're going to do with all the people who took care of the horses, etc., etc. This will increase productivity, and it will allow people whose minds are engaged to engage them somewhere else, which is called progress. And it'll be in fits and starts, and it'll be messy, and it's like any major transition. I can remember when Microsoft came out with Word, and we bought our first computer 40 years ago. I said it's an expensive word processor. Boy, was I wrong. And it became, and it made us as a little company be able to do 10 times what we were doing with the same number of people. No one lost their job. We employed ourselves to doing more business because we weren't spending our time doing details. AI will do the same thing, and some people will have to reshape themselves.
Yep.
So for people like me, who are getting a little long in the tooth for that adventure, I'm going to have to let the young people do that. But there's plenty of them, and they are adaptable, and those that are will have work and make money, and those that aren't will have to learn how to deal with it and deal with it. So I'm not worried about it long term at all. Next couple of years, it's going to be a hot mess, as Kim likes to say.
Well, I couldn't agree more. I think that, just look back at when, the internet was invented. Look at the jobs that we have and the careers that exist today that weren't even on the radar 25 years ago, weren't even a thought. And to Frank's point about progress, and when now you can do something differently, it opens up the door for so much. So I do think that things will change. I think it's extremely exciting. Not that AI doesn't come without its challenges from a security and perspective. Those things are, you know, really challenging and need to be handled with extreme care. But when you look at the application of AI with businesses, I just think that there's an awful lot of opportunity ahead.
I'm
Go
going
ahead,
to
Kim.
agree heartily with everything you guys have said. I think it's an excellent reminder that the secretaries that used to populate a lot of businesses, they weren't fired wholesale whenever people could write their own emails and do their own correspondence. They got absorbed into better, more interesting jobs than just typing up stuff, right? And I think that's what's going to happen here. I also think this highlights what journalism has become, is we get fear-baited headlines that make you read the article. And I wish we could dial that back, because it's exhausting for me to read news sites, and that's what I get paid for, right? To read news and figure out what's going to happen next. And it's just really exhausting. So journalists, if you're listening, please back it off a little bit. The end of the world is not nigh.
Good luck with that, Kim. They still have to sell the newspaper.
I know.
I can end on a dreary note. I was reading a research article over the weekend about sort of AI, and their kind of conclusion was that if artificial intelligence can sort of do everything better than a human can, that is one that's going to be able to eventually outsmart a human. And so they estimate, I don't know how they got to this estimation, but they estimate that there's at least a 50% chance that superhuman AI will lead to human extinction. So, take that into the work week, and good luck out there with that, I think.
How many decades are they talking about?
I have no idea. I kind of chuckled at that. I don't know how you can kind of get to that point. They also think there's a multiverse out there where, that might just be controlling all of human existence anyway, but it is something to think about.
AI will never dig a ditch. It will never build a house. Okay.
They'll just make us do
Until
it.
it runs
They'll be so smart that they'll make us do all that stuff, and then they'll control us.
I guess
You know what?
When it starts running the 3D printers, it will do everything, I guess.
Yes. Just go back and about, I don't know, 50 years ago, 60 years ago, Isaac Asimov wrote just about this in his science fiction novels. So you never know. H.G. Wells also talked about some things that came through. And we had Mary, I can't think of her last name, who wrote about Frankenstein. And it ended up in
Mary Shelley Godwin.
Yep. So you never know. We have yet to see a Dracula come back around, though. But that's one of those. All right. Thank you so much.
Mary Shelley Godwin is.
Yeah. Well, thank you for joining us once again for the Bull, the Bear, and You. We'll continue our look at investing in our next episode. And since you're watching or listening to this program, I ask that you hit the subscribe or the like button on whatever platform you happen to be using. Once again, thanks for joining us. We'll see you again on the next edition of The Bull, the Bear, and You.